If you make more than $50,000 a year, if you own a home, if you have a retirement account, then listen carefully. Because 2026 could be the year the IRS quietly takes more of your money than ever before. Not because you cheated, not because you're rich, but because the rules are changing, and the middle class is the easiest target. Most Americans won't notice these changes at first, until their refund disappears, until their property taxes jump, until the IRS already knows exactly where every dollar is coming from. Today, I'm going to break down 3 new IRS tax rules coming in 2026 that could seriously damage middle-class finances, and more importantly, how to legally protect your money before it's too late. Stay with me, because the last rule affects almost everyone, even if you've never invested in crypto. So why are tax laws changing so aggressively right now? Because the U.S. government is under pressure, like never before. National debt is exploding. Inflation crushed purchasing power. Social Security is running out of money. And Medicare costs are surging. Politicians love to say they'll tax the rich. But here's the problem. There aren't enough rich people to pay for everything. So instead, the IRS is turning its attention to people who earn steady income, own assets, file taxes honestly every year. In other words, the middle class. And starting in 2026, several adjustments, some already proposed, others quietly enforced, could change how your money is taxed forever. Rule number 1, the silent expansion of unrealized gains, pressure. This first threat is something most Americans never thought they'd face. Taxes on money you haven't even received yet. Traditionally, you only paid taxes when you sold something, a house, a stock, a business. But policymakers are now pushing the idea that just owning an appreciating asset means you should pay more, even if you didn't sell, even if you didn't cash out. While full unrealized gains taxes are officially aimed at the ultra-wealthy, 2026 expands reporting, tracking, and valuation rules, and the middle class gets caught in the middle. Here's how this hits you. Your home value goes up, your income stays the same, but your tax exposure increases anyway. You feel richer on paper, but poorer in real life. That's not wealth, that's pressure, and it's one of the quietest ways the middle class gets squeezed. Rule number 2. Retirement accounts are no longer untouchable. The second change is even more dangerous because it targets your future. For years, Roth IRAs were considered safe, predictable, almost sacred. Tax-free growth, tax-free withdrawals, a clear retirement plan. But that certainty is fading. By 2026, lawmakers are actively discussing new Roth income limits, mandatory distributions on large Roth balances, tighter restrictions on Roth conversions. Why? Because trillions of dollars are sitting in retirement accounts, money the IRS can't easily tax later. And the government needs revenue. This doesn't mean Roth IRAs disappear overnight, but it does mean the rules can change after you already played by them. That's the real risk here. Not just higher taxes, but uncertainty. And uncertainty destroys long-term planning. Rule number 3, total digital money visibility. Now we get to the rule almost nobody is prepared for. Total digital money surveillance. By 2026, the IRS will have near-complete visibility into payment apps, online platforms, side income, crypto, yes, even if you don't use it. Reporting thresholds are shrinking. Automation is increasing. And mismatches are flagged instantly, no human required. If your bank reports one number, your payment app reports another, and your tax return doesn't perfectly align, the system notices. For the middle class, with side hustles, gig income, or multiple accounts, small mistakes can turn into penalties. Penalties turn into debt. How to protect your money? Legally, now take a breath. Because there are ways to protect yourself legally, safely, and without doing anything shady. Rule number 1, control when you pay taxes, not just how much. The wealthy don't just lower taxes. They control timing, strategic withdrawals, smarter income planning, using deductions at the right moment, not randomly. For the middle class, planning beats loopholes every time. Rule number 2, reduce chaos, not compliance. This doesn't mean hiding income. It means clarity, separate accounts, clean records, clear documentation. Because when the IRS looks at your finances, chaos costs money. Clarity protects you. Final warning. Here's the uncomfortable truth. The tax system isn't being redesigned for billionaires. It's being redesigned for people who own homes, save for retirement, don't have lawyers on speed dial. 2026 isn't about one massive tax hike. It's about many quiet changes that add up over time. If you wait until everything is official, you're already behind. The middle class doesn't lose because they're lazy. They lose because they weren't warned. Now you are.